Welcome to our webinar on the Consumer Protection Code Review, part of our A&L Goodbody regulatory series. I'm Dario D'Agostino, I head up our regulatory investigations group, and I'm joined today by a number of cross-disciplinary members of our team overseeing these reforms. Patrick Brand is head of our Financial Regulatory Advisory Group. Laura Malidi is a partner in our insurance and reinsurance team. Laura Corrigan is a senior associate in our regulatory investigations group with experience of supervisory reviews and enforcement in many consumer issues. And Louise Hogan is a senior associate in our financial regulatory group focusing on payments and fintech. The review of the Consumer Protection Code is a crossroads of a number of different regulatory reforms. First, there are the standards for business regulations, and they represent the business standards which are part of the individual accountability framework, and they're principles-based standards that apply to all regulated firms regardless of your customers. Secondly, there's the much-awaited review of the Consumer Protection Code. And this reflects the central bank's experience in a number of supervisory and enforcement engagements across the retail space in recent years. And it aims to put in one place the requirements from the current Consumer Protection Code and other codes such as the CCMA. And thirdly, and more broadly, the review reflects certain additional policy agendas. These reflect evolving markets and technologies and cover topics such as digitalization, climate risk, informing customers effectively, and engaging appropriately with customers in vulnerable circumstances. And the central bank's approach here is a much more principle-based one. For example, the guidance on securing customers' interests requires firms to review and consider the case studies in that guidance and to apply them with what they say is the right mindset to your governance, decision-making, product design, and systems and controls. There is a huge amount of information to take in here. There are both new concepts, new principles, enhancements to requirements, technical tweaks to all of these consumer issues. And what we'll aim to bring you today in our webinar is to let you know what's entirely new, what are some of the key enhancements, what types of action is required of your firm by these requirements, and what you can start to do to prepare now. We can't cover the over 300 pages of regulations and guidance, but what we will equip you with today is a methodology for reviewing, understanding, and starting to think about implementing some of these requirements. And to help you with this, our team has prepared a detailed ALG guide to the Consumer Protection Review, which we'll be sending to you after this webinar. So to kick things off, just to understand the scope of these reforms, Louise, can you talk us through some of the threshold requirements and who this all applies to?
Sure. Well, there's a couple of changes on scope. Firstly, the CPC doesn't apply to any additional types of regulated entities. So in terms of those that will be authorised under the MICA regime, the central bank hasn't looked at those yet. What will change will be that entities that were subject to only part of the code will now need to comply in full. So for example, those providing buy now, pay later type products. In terms of the definition of consumer as well, that's another thing that's changed. So an SME is now not just one with a turnover of 3 million, but those up to 5 million. And that reflects the first time that that figure has changed since 2006. And then finally, the scope of the business standards is very wide and currently intended to apply to all types of regulated entities. A couple of small exceptions being MiFID firms, crowdfunding providers, and for the moment, credit unions.
And it's interesting, we were discussing before that the business standards, unlike the Consumer Protection Code, doesn't refer to consumers or customers in Ireland. It just says it applies to regulated firms in the conduct of their affairs. So it remains to be seen whether that should apply more broadly than in relation to Irish customers.
Yeah, that's right. It's definitely broad. And then the other thing about scope to think about is that even though this doesn't apply to MiFID or crowdfunding service providers, there is definitely that expectation from the central bank that the guidance on securing customer interests is considered when they are considering that duty to treat customers fairly under the MiFID and crowdfunding regimes.
And moving on to the business standards, that's entirely new. And Patrick, from a more general perspective, these apply to all regulated firms. So what better place to start? Can you tell us about the key pieces of the business standards?
Thanks, Darian. That's right. So the regulators spent a lot of time thinking this through. So what the central bank proposes is a restructuring of the CPC's current general principles. So first, there'll be a restatement of the CPC high-level principles into high-level business standards. And then there'll be a number of so-called supporting business standards, which effectively expand on that high-level framework. It's probably worth stating that the current CPC general principles, like all the current CPC general principles, all the business standards will apply to regulated firms' relationships with customers and not just consumers. There's going to be one exception to that, and that's going to be the requirement to secure customers' interests, and that applies only to engagements with consumers. But it's fair to say that in relation to B2B engagements, a lot of these principles will effectively, these standards and principles will apply. So turning to the new high-level business standards, a lot will be already familiar to our audience. So in some respects, there will be some enhancements, but in effect, you'll have the requirement to act with honesty and integrity, the requirements to act with due skill, care, and diligence. There's also an acting in customers' best interests provision as well. But there will be some entirely new provisions, such as the requirements to secure customers' interests that we'll be talking about a great deal during this session. There'll be new general requirements in respect of financial resources and internal controls, which is quite prudential, not so much conduct of business. There will also be a requirement to control and manage affairs sustainably, which is a nod to some of the ESG-themed reforms that we'll hear about a little bit later, and a new general requirement to cooperate with the regulator.
And Patrick, you mentioned the supporting business standards. Are these a departure from how the central bank usually regulates?
I would, in general, I agree with that. I mean, we're going to have a lot of these points discussed in our ALG guide, which will be released, after this particular session. But the main points are, again, securing customer interests. Again, entirely new, unlimited to consumer engagements. But there's a significant amount of detail, and there's going to be guidance in relation to this, which is currently in draft forms. So some noteworthy areas: firms must have a cultural control and governance framework that takes customers' interests into account. Firms must act in accordance with customers' reasonable expectations. They need to ensure that products and services are not designed to unfairly exploit customers' behaviors, habits, preferences, or biases. There are also requirements on how to address and remediate customer complaints and errors. Firms will need to ensure that there's an appropriate distinction between regulated and unregulated activities in order to avoid this so-called halo effect. And finally, there's a reference to delivering fair outcomes for customers, which raises questions as to how far this goes. Does it, for instance, I think there's a point that we discussed recently, does it mirror the UK consumer duty with its focus on achieving certain customer outcomes? So beyond the customer-focused provisions, there are new provisions relating to engagements with all customers, which would be good to draw out. So firms will need to have internal controls to counter the risk of financial abuse of their customers. Now, while the supporting standards refer to a number of systems and controls which many firms already have in place, there's going to be a broader requirement to monitor trends relevant to the risks arising from that firm's customer base, or more generally from the sector they operate.
And that's interesting. That's probably the first and many times we're going to come across a new requirement to review your own performance or your own engagements.
Yeah, agreed. Just finalising this particular point. There's going to be we talked about regulated cooperation provisions. Currently, there's a patchwork quilt. I'm not saying that they're all these regulations will disappear, but we'll have one supervening requirement to effectively be open and cooperative with your regulator, rather like FCA Principle 11, disclose anything of which the regulator would reasonably expect notice.
And everything you've mentioned there, those last few points, they relate to engagements with consumers, but of course the business standards can apply to any customers. So what about larger firms that don't have consumers as customers?
Yeah, I mean, I wouldn't say problematic, but there's a fair amount to think through. So in relation to TCF, as you say, these particular standards apply to customers. So queries the extent to which they impact on B2B relationships. Again, the actual precise extent of the obligations need to be determined and carefully thought through. I mean, my own feeling is that wholesale importation of consumer protection provisions appears inappropriate, especially if you have a large lending platform with a large syndicate, But a view that their customers, the underlying customers, don't need to be treated fairly at all would appear to also go far. So the question is, where do you draw your line? And I think it'll be very much on a business line by business line basis, and probably on a customer by customer basis as well.
So they're the business standards and the supporting standards, and you referred there, Patrick, to securing customers' interests. And I'm just going to come on to the guidance on securing customers' interests to set the scene for this entirely new concept in engaging with consumers only. And the guidance sets out the central bank's expectations and objectives when firms are engaging with consumers. Here are the kind of things the guidance says as a scene setter. It says that firms should consider the actions that are required of them and adopt the right mindset when engaging with consumers. It refers to the importance of firms having a collective understanding of what securing customers' interests actually means and the behaviours that are expected. And it refers to incorporating customers' interests into culture, strategy, decision-making, to ensure you offer availability and choice and that you enable consumers to make fully informed decisions. And the guidance covers a number of areas such as aligning strategy, decision-making and system and controls with customers' interests, product design, handling potential customer biases, handling errors and complaints management, the clarity of contracts and how to deliver fair outcomes for customers. We're not going to go through the guidance line by line, but we're going to give you some of the themes we think are important for you when you study it. First theme is this about the substance or just the process? It remains unclear how far the guidance is intended to influence or regulate substantive outcomes when it comes to product attributes or service levels, compared to what processes you follow when engaging with customers. So guidance comes a little close to talking about the substance of what you offer customers, when it refers, for example, to designing or renewing products and a requirement to consider the risks involved in your target market and pricing. Now, that sounds a little bit like the substance of the UK Consumer Duty with its focus on customer outcomes, for example, value for money. But most of the guidance, and we think rightly so, focuses on the process you follow when engaging with customers. So one example of what good looks like is one of the case studies dealing with incentives. And it says it is important when dealing with incentives in your engagement chain to ensure that when they're offered, they deliver positive outcomes for customers and they support effective decision making rather than influencing adversely those decisions. Another theme is proactivity. The guidance makes clear that firms should be proactive in their approach to identifying and assessing potential customer impacts. So the guidance, for example, emphasizes the importance of reviewing your engagements with products and product renews after the event. And it also calls out very clearly that firms are expected not to wait for the central bank to intervene if you've identified a potential customer detriment, to investigate it, to assess who's been impacted, and design and implement redress. Another theme that comes through the guidance is embedding customer interest throughout your entire product lifecycle. I think, Louise, you've been giving this some thought.
Yeah, one thing that is interesting that they have focused on is, I suppose, those post-sale activities and ensuring that there's no unsuitable or unfair outcomes, or if they are, that you have detected them. So how would you do that? 2 examples they have put in the review is monitoring of calls on an ongoing basis, so those kind of call center calls, and then ongoing reporting of KPIs. So I think they are probably more helpful than what had previously been in the code.
And I think also, just to mention here, one thing I know that we've been thinking on is whether firms need to reflect on whether they should have a dedicated consumer champion in their business to really help deliver on all these new business requirements.
And we've seen that particularly in retail banking, but now it's something to think about more broadly in consumer businesses. That's a good lead into another theme, which is the expectation that you'll extrapolate learnings from some previous failures, study the case studies and the guidance, and apply it in practice to your own business and products. There's a lot of reference in the guidance and the commentary to the tracker mortgage examination, retail banking, and business interruption insurance issues. And if you take the tracker mortgage experience, the central bank there during the market-wide reviews was focusing not just on interpreting customer contracts, but also thinking about whether you've complied with the general principles of the Consumer Protection Code as an overlay, and also separately, what are the reasonable expectations of customers and what kind of products do they think they've purchased. On interpreting contracts, the guidance reinforces some of that approach and says in very clear terms that if there's a material ambiguity in your customer contracts, you should interpret it in favour of your customers. It doesn't really get into what you do, for example, if one interpretation could be favourable for one group of customers, but might be detrimental to another. And that's something you really just need to work through in practice. And that concept of different groupings of customers is another theme that came out of tracker mortgages. If you are treating different cohorts of customers differently, you really ought to have an objective reason for doing so. And that's most relevant when it comes to dealing with customer complaints and errors. You're expected now to pull the thread to assess the scope of an underlying issue, identifying the group of customers that might be impacted, and address that accordingly. And then there are references to assessing the impact of your actions and decisions. And an example given by the central bank is the decision to withdraw tracker mortgage products from the market in 2008, thinking not just about customers' entitlements to these products, but also their reasonable expectations as to whether they would be available and what would happen if they're withdrawn. And there's also lessons to be learned from business interruption in the insurance context. And I know, Laura, you've been looking at that.
Yeah, absolutely. So while similar in a lot of ways to the experience with tracker mortgages, in the insurance context in particular, test cases became very important. The business interruption supervisory framework issued by the central bank really emphasised the importance of fair process. So if a decision went against an insurer, that the insurer would then be ready to make things right with a cohort of customers. And then also they needed to be ready on how costs would be handled. Very much the expectation that you would have a business that didn't expect to be at the centre of a test case like this.
So some of you today might ask, well, what have tracker mortgages and business interruption policies got to do with my business? Well, welcome to the new world. The regulator is expecting you to look at these other issues in the market, the issues that are highlighted in the guidance, and extrapolate them to your own business and your own products. There are a number of case studies in the guidance. They cover things like target markets and delivery channels, differential pricing, avoiding a halo effect from regulated versus unregulated business lines, and dealing with contractual ambiguities. But here are just some of the practical points that seem to be dotted throughout the different case studies. So there's a case study on digitalization, and that focuses on ensuring that these new channels are easy to navigate, to use and understand, and that firms assess the risks arising from those channels before you actually implement them. There's a case study on incentives in product design, and it makes it clear that it's important to very carefully assess the rationale for incentives and to ensure that they don't unduly influence customers' behaviour. There's one on green and sustainability products. It refers to potential information asymmetries and making sure, again, that that doesn't adversely influence customer decision making. And there's a case study on delivering positive outcomes for consumers. That's really getting at the information that's provided to customers and ensuring that they are fully informed when they're making decisions. And there's reference, for example, to some consumer behavioral studies that show just tweaking the information you give to customers can make a real impact when they're deciding to take up different options in your products. So Louise, Patrick referred to the increased requirement to have internal reviews at different points and cycles for different products. How should firms stand back and attack and digest these new reforms?
Well, I suppose step one is just to assess what's there and why is it different for your business. So for example, talked about the change in the definition of an SME. Will that change how you onboard customers, whether you're classifying them as consumers or what the classification will be from a CPC perspective? Step two will be mapping your compliance. So hopefully you're only trying to look at what's new or if there's enhancements, but if there's some issues with compliance at the moment, you might pick them up when you do that exercise. The third one is probably the most important part, which is internal stakeholder engagement. So this really isn't just a compliance issue. So I think Laura will talk a bit later on digitalization, but really a CPC project is going to require business input from the product side, UX, on the operational side, marketing, sales, customer communication. Really need to think about the people who are feeding in from those sides of the business. And then I suppose once you have that engagement, it's about designing and upgrading your controls, your governance, and those product pieces. And I think what's important to say is that there'll be a lot of people feeding in from different parts of your business. So the timelines will need to line up if you need a product enhancement or you need to update customer communications, that you're feeding all that into the project as well. And then the final one is governance. So making sure that those in charge understand what the changes are, the significance of them, but also the spirit of the changes and the spirit of the code.
So that's how you should come at all of this, but what is this? And first of all, we'll start by asking ourselves, what is entirely new? And Laura, I think you've been giving some thought to some of the important aspects of the entirely new concepts.
Yeah, so honing in first on two entirely new whole sections, digitalization and sustainability and climate. Starting with digitalization, and you've touched on this already, Dario, we have these new requirements because these are new sales channels, and the central bank expects firms to support their customers to harness all of the great benefits that these new ways of doing business will bring to them. But it also wants firms to consider the risks around this. What risks and threats do consumers face from increased digitalization, and what steps can the business take to help mitigate those risks? We were talking about this earlier, and I was saying I'm particularly interested in this chapter as it's been, digitalization in the insurance sector has been talked about a lot for the last number of years, and there's been quite a lot of engagement, most recently on governance around digitalization, but also on data ethics. So the central bank has been working on all of this alongside its preparation for this CPC review.
No, that's interesting as a new concept. So tell us a little bit more about what's in there in the detail.
Yeah, so first, the digital platforms have to be designed for use by consumers without consumers needing to have that specialist knowledge of how the platform works and how it was built. So the platforms have to be easy to use, to navigate and to understand. And that all sounds quite, straightforward and sensible. Next, both the platform and the algorithms that sit behind it, they have to be designed to produce objective and consistent consumer outcomes. And both the platform and the algorithms have to have been appropriately tested. Now, exactly what appropriately tested means is probably open to debate and different views. Firms are going to have to give really clear and effective guidance on how you use the platform. And they'll also have to give information on assistance to customers.
And what does that positive assistance look like? That's new.
It's not specified, but when you think about all of the concerns that have been raised about the impact of digitalization and the sort of taking the human interaction out of the sales process, I think we can probably expect that it's fair to assume some level of human personal contact in that assistance. And then the last one I'd mention, digitalization, is there's going to be a specific requirement for firms to allow consumers to filter product options where they're offering more than 3 choices for the same for a product of the same type. And there is going to be more guidance given by the central bank on this.
And another topic you were looking at was sustainability and climate. So tell us more about that.
Yes, so absolutely new in terms of the code, but not new overall. It's a pull through from lots of different sources. As we all know, there's a huge regulatory focus here in Ireland and in Europe on making sure that customers really understand the sustainability credentials of the products and services that they buy. For that to happen, obvious as it may sound, greenwashing has to be avoided. So the central bank is taking very specific steps to help ensure that outcome through introducing new advertising and suitability requirements. On advertising, firms are going to have to make sure that their advertisements don't mislead customers on the sustainability credentials, either of the products they're offering or indeed of the sort of the firm and the firm's business model. And then on suitability, firms are going to have to consider customers' sustainability preferences as part of the suitability assessment process. That's not entirely new for some sectors. Insurers and insurance intermediaries have been subject to this for the last 2 years. So this isn't going to be new to them, obviously.
And how have they got on in practice with those requirements?
Maybe surprisingly quite mixed. To do that really well. So to make sure customers understand what they're being asked when they're being asked what their sustainability preferences are, and that the products are being explained to them in the right way. You need your people to be really well trained, and you need them to understand the products really well themselves. And for the more sort of everyday consumer products, I think the feedback the central bank got was that actually some consumers just weren't that interested in being asked all of these questions.
So overall, there's a real embedding of these sustainability requirements in all of your engagements with customers.
Yeah,
now.
absolutely.
And if I could just come in, I think another important development worth mentioning, and it's on the topic of vulnerability. So I think not surprising to many of us that vulnerability was a real key theme and real focus that came out in the feedback received on the discussion paper. I think it's also one we've received quite a few questions on in advance of today, so clearly on a lot of people's minds as well. And first thing I suppose worth mentioning is the definition. So the definition of vulnerable consumer will be replaced by a new definition, and that's going to be about consumer in vulnerable circumstances. So I think what all that means is that the assessment of vulnerability is going to be based on individual circumstances which make them more susceptible to harm. So consumers can move in and out of vulnerable circumstances. The central bank has been quite clear it's not a permanent condition or long-term medical issue. And for example, in the guidance it noted it could arise due to bereavement perhaps or temporary ill health. And then one other point to note, and it's really the key aspect, is the training that's going to be required in all of this.
And that's another theme, as well as internal reviews, is the theme around kind of training and monitoring training to make sure people turn up and they do it. That's new.
Exactly. So here the proposed changes include new requirements for firms to train their staff to ensure they understand things like key signs and indicators of vulnerability, practical assistance and supports available, and also how to recognise and respond to exploitation and abuse and what procedures they should follow. A key point I thought was really interesting is the training does extend beyond staff and simply customer-facing roles. It goes to kind of all aspects of the business in terms of advertising, product design, marketing. So really the full spectrum there. And then also to mention a governance change as well. So firms are going to be required to conduct a review at least every 2 years to ensure that they're satisfied that they're meeting these new training requirements. So a lot of new changes there.
And again, there's that concept of reviewing your own compliance again, which Patrick referred to before.
Exactly. And again, one other important development I think here is the proposed introduction of a new role known as a trusted contact person. So this I think is going to be really helpful to firms and customers, but it enables customers to provide details of a trusted contact person who they can put on the record effectively for a firm to communicate with if they have concerns that the customer is perhaps subject to financial abuse, or where there may be a difficulty in communicating with the customer. So I think probably resonates with lots of people that this may be a practical support that could really be useful to customers and their families if a difficult situation arises.
And Laura, you mentioned before there countering financial abuse, but there's also this new kind of policy heading of frauds and scams. So is there anything else on that?
Yeah, there is. And I suppose unsurprisingly, it falls within the proposed developments of vulnerability, because I think, as we know, often frauds and scams are targeted at vulnerable customers, but obviously not always. So there is going to be a new requirement for firms to ensure they take steps to protect their customers from financial abuse. But I think the key observation here from our perspective is the definition of financial abuse is extremely broad. So it captures online frauds and scams, but it also captures offline frauds. So for example, any frauds that may be conducted by way of power of attorney or guardianship arrangements. So as Patrick mentioned earlier, firms are going to really need to have clear policies and procedures in place to enable staff to really report these concerns. That a consumer is a victim or is at risk of being a victim of financial abuse.
And it's probably worth saying, just I think would be of interest for our fintech clients, particularly that we already have some rules around kind of scams and fraud in AML and in the payment services regs and the new payment services regulations. So the aim of this really is to be supplementary to those rules they're already complying with.
So that's a helpful highlighting of some of the new concepts, new policy areas. In terms of moving on to what's enhanced from the old rules, I mean, there's a myriad of tweaks in there. Patrick and Louise, you've been looking at some of the enhancements. Can you give us some of the highlights? Sure.
I mean, in relation to suitability, and I think Laura covered this a bit earlier in relation to sustainability preferences and ESG more generally. In-scope firms are going to be subject to effectively an enhanced suitability assessment process. So they're going to have to obtain information on customers' sustainability preferences when they issue their own suitability statements to those customers as a result of identifying the product which they think is the most suitable. They'll need to effectively give vent to those sustainability preferences, and they'll also have to identify whether there are more suitable products. Now, granted, MiFID investment firms and, as Laura mentioned earlier, insurance intermediaries have been subject to similar types of rules since August 2022. Yes, there's an enhancement. It'll be fairly new for some types of intermediaries. Realistically, I think there's an element of future-proofing in relation to these rules. Laura mentioned the anecdotal evidence a bit earlier of, in the insurance world, of customers not particularly engaging well. I think you can say the same in relation to investments. Especially in relation to plain vanilla investments. But we suspect that, given the current environment and effectively regulator nudges, and also probably more consumer awareness of these types of issues, these particular rules will probably be, first of all, groundbreaking at the moment, will become business as usual over the years to come.
Particularly for a whole new generation of customers, yeah.
I think advertising is an area of enhancements that is particularly interesting. So you've got a lot of changes in what can be in the advertisement itself. So really emphasizing around not misleading customers, having the hyperlink in their disclosures. But there is also a change in the approach to advertising and the approach to marketing. So there will be an annual review of advertisements required, but there's also a requirement to keep records of those reviews. So there's that element again of the concept of increased internal reviews in firms. And it's really important to forward think on this and say, if I'm trying to demonstrate compliance to the central bank with this, how will I do that? And I suppose documenting the approach and the thought process that led up to the advertisement.
And Patrick, I know you've been looking at the interaction between conflicts, commission, remuneration. So anything in there?
Yeah, I think there are enhancements stroke tweaks. I mean, our view broadly is that not much has changed, given that there were a variety of MiFID-like rules introduced to the current stroke old CPC, that they were designed to tackle soft commission arrangements and other types of prohibited commission structures. But I think the general point is more of a big picture item, is that when you look at these particular enhancements against the lens of securing customer interests, we believe that commission and other non-monetary benefits will become more of a regulator focus. So we'll see more types of intermediaries looking at these types of rules, or being asked to look at these types of rules more seriously than perhaps has been the case hitherto.
And I think probably just more generally in relation to the SME protection. So we've talked about how the threshold is increasing from 3 million to 5 million. The new standards and supporting standards will apply generally when doing business with a small business or an individual. But there's also going to be consolidation of the SME rules into this. And I suppose just to remember, it's still a consultation, and the central bank are really looking for views on whether it's appropriate for those small businesses.
So there are just some of the technical tweaks and enhancements throughout the CPC rules. There are other enhancements that you might say are more reflective of, again, the central bank's experience in some of the areas the last while in the retail space. And error management, complaints handling, that's a key focus. So Laura, anything else in there in terms of enhancements?
Yeah, definitely a couple of things to mention. So on errors management, there have been a number of important enhancements. So these are really focused around the requirement to have robust governance arrangements in place. And two things I think worth mentioning are, firstly, significant errors must now be detected, classified as such, and urgently reported to the board. I think in terms of the observations on that, there's no definition of what a significant error is at the moment. So the categorization appears at the moment to be at the discretion of the firm. And secondly, there's no real guidance on when the urgent reporting to the board should occur. So does a firm need to perhaps arrange an out-of-course board meeting if an issue is identified? So really, firms are going to need to have policies and procedures in place to manage all of this. And secondly, the requirement to analyse patterns of error at least once every 6 months and report this to compliance or risk, and again upwards to the board. And it should be reported along with the number of errors handled and resolved. So a kind of joint MI there. But the analysis is similar, I suppose, to that's already required under the complaints handling obligations under the current CPC. So I think it does show us that the central bank is really focused on expecting firms to pull threads and really determining whether an issue may be systemic.
So that's handling errors, but there's been a lot of focus by the central bank on complaints handling. We've seen some enforcement actions actually refer to how complaints were handled or not handled. So is there any more on complaints as opposed to errors?
There is some more on complaints as well, which kind of are similar to the errors enhancements. So firstly, the requirement for firms to have systems and controls in place to track and manage complaints. Now we know that firms already have these systems in place to manage their current obligations under the CPC. But secondly, there's again a new requirement to have robust governance arrangements in place for the appropriate handling of complaints. And the arrangements must include the following 3 items. So processes for the proper oversight of complaints handling, complaint pattern analysis at least once every 6 months. So as I said, already required under the CPC, but now expressly includes complaints that have been resolved within 5 working days. And thirdly, arrangements for reporting to the compliance or risk function and to the board, again, the number of complaints handled and resolved and the outcome of the complaints pattern analysis. So importantly, really, governance documents are going to need to be updated to ensure that all of this features as a standing board agenda at least twice a year.
And there are new requirements for complaints, but how about enhancements in the area?
So enhancements, again, I suppose sticking with the theme of complaints pattern analysis. As we know, the firms already need to have a complaint log setting out the details of a customer complaint. It must now include the core reason for the complaint in order to facilitate analysis of the complaint by category. And this is something that may be an addition from something like the tracker mortgage examination, where we know that patterns of complaints require close analysis to determine whether particular groups of customers had been impacted by the issues there.
So they're some of the principle-based enhancements of some of the code requirements, but some industries do take up more ink than others, and insurance is a perfect example. So Laura, what's new in there for insurers?
Yeah, so there's quite a lot of fairly subtle changes. There are others that are more major that look new but actually aren't new. So all of the price walking regulations have been lifted and dropped in, and those regulations will be repealed. So that obviously took up quite a bit of ink. I won't speak to those sorts of changes. They've been worked through by firms over the last couple of years. But starting with one completely new requirement that has been much discussed, and it was to have been brought in at the same time as the price walking regulations came in, and that was the proposed introduction of explicit opt-in requirements to be introduced for automatic renewal of pet insurance, dental insurance, travel insurance, and gadget insurance. But it's not going to be introduced for the more, what are seen as the more critical types of insurance, motor insurance, home and health, where the potential consequences of a consumer being left off cover are just too serious. So that's a bit of a balance by the central bank in making sure that there is choice and shopping around, but actually certainty and people not falling off cover. And then touching on a few of the more subtle changes, there are going to be some additional restrictions on phone contact with prospective customers, where those customers come to a firm through a digital platform. Firms will have to get express customer consent before they engage with them at the firm's instigation over the phone. There are some enhanced, really just modernised requirements around confirmation of cover for policies taken out through a digital platform. So there'll be a requirement for the insurer or the intermediary to confirm cover immediately at point of sale. Then there's also enhanced, again, modernised requirements around the mode of communication of decisions to refuse to quote for home or motor insurance. And for a long time, there's been a requirement that the detail of those decisions is provided by way of a durable medium. And now that's going to become an option rather than mandatory. There are some minor changes around premium rebate timings. In some cases, they will move from 5 to 10 working days. And then I think the last one I'll mention, and it's quite a niche point, but one that we in the insurance team were kind of quite focused on. Currently, if an insurer is transferring its business, closing down, merging for all or part of its business, there's a requirement to contact consumers 2 months, at least 2 months. This is a requirement to give consumers at least 2 months' notice of the decision to do that. That is now going to change to 6 months, and it'll apply across the board to all types of regulated businesses, but it has particular bite for the insurance sector because of our processes for transferring portfolios and court timetables, etc. So that's one that we wonder will some be feeding back on the consultation on.
So a lot of changes in there, but many of them driven by the new concepts of, say, digitalization.
Absolutely.
And Patrick, moving on to banking, you've been looking at this through a banking market lens.
Yeah, so on consumer lending generally, we believe the main action is on mortgage arrears and vulnerable customers. In relation to detailed rules, there are provisions in relation to lifetime mortgages. These are, they've been on the market for quite a while, but they're actually now more widely used. There are, obviously mortgages that go beyond the usual 25 to 30 years, and they effectively mature towards the end of one's life. They're becoming more prominent, so there's greater need for warnings in relation to those, especially if there are aspirations in relation to inheritance as well. Okay. More generally, there are enhancements in relation to disclosures. There are certain prescribed disclosures that need to be made to customers. These have been tweaked, and firms will have to amend the systems and controls to make sure that those particular amendments are effectively uploaded to existing and future document suites.
And Louise, you've been thinking the same thing for investment services.
Yeah, so for investment services, it's really limited to that piece around securing customer interest. So MiFID firms or those providing MiFID services should already be familiar with those kind of disclosures where you're providing clear, fair, and not misleading information. I think more generally, if you're providing a mix of products and including unregulated products, you'll have to comply with that rule to make customers aware of the regulatory status of the products that they're receiving. And then we were also having a look at the pensions sector. So on pensions, the central bank review says that effective disclosure on pensions really encourages customer engagement throughout the cycle of the pension. So firms will be required to inform their customers of the importance of considering ongoing suitability. And I suppose it's not just about the point of sale, it's about the annual statements as well. And then if firms are not doing that, they should be telling customers why not.
So when you stand back from all of this, what type of action is required of your firm from all of these reforms? Again, we can't cover each and every detail, but hopefully we gave you there a flavour of what's enhanced and at least a framework for looking at this and saying, what does this mean for me and my firm? So what categories of actions are required by the new requirements? And just here's a list of the kind of groupings we think are relevant. So first of all, enhanced governance arrangements. There are more references to robust governance arrangements in these requirements. So Laura Corrigan referred to the requirements to have those kind of governance arrangements in place in relation to the handling of complaints and engagements with vulnerable customers. Laura Malidi referred to the same principle when it comes to digitalization. Then there's increased board involvement. We heard Laura mention about how boards should now receive reports every 2 years regarding new staff training requirements for engagements with customers in vulnerable circumstances, and new requirements to escalate significant errors to the board urgently rather than in a particular board cycle. Then a lot of discussion around more regular internal reviews. So Patrick mentioned certain of those reviews in relation to target markets, and a new requirement that Louise mentioned to annually look at your advertisements, the information in there, albeit after the event. Then there are enhancements to customer documentation. So not only tweaks to, say, pre-sale information, but also thinking about the principles and the business standards about informing customers effectively, not just what your contracts say, but what all your written communications with customers say and what they understand it to mean. Then there's updates to policies and procedures, not just ensuring that the right information is given to customers at the right time, but also specific processes. Laura mentioned opt-in arrangements in insurance, and it's important to think more generally about your customer journeys. Then there's updates to product design. So firms probably need to go beyond the sectoral guidance you might be following, for example, with banks, the EBA guidance on product design and governance and oversight. Patrick and Louise mentioned some of this in the context of investment services, payments, but it applies to every regulated firm. And finally, more and revised training. So we've heard that there are new requirements in relation to engagements with vulnerable customers, thinking about delivery channels, thinking about looking at your call center arrangements, your scripts for engaging with customers, and more detailed training on some of these enhancements is going to be critical. So at this section, I'd like to then come on to our panel and just ask, there's a lot of change there. Could each of you give me one positive thing coming out of the changes and perhaps one challenge you see?
Yeah, I'll go first there, Dario. I think in terms of the positive change, all of this gives a lot more guidance to firms, I think, on the regulators' expectations. And it also offers and provides some good support in terms of challenges that firms are facing around frauds and scams, vulnerable customers, etc. I think in terms of a challenge, I think navigating all of the proposed governance arrangements that are going to be required by the new regulations will pose a challenge, particularly as we've mentioned earlier, in terms of errors management, the classification of significant errors, the escalation of that urgently. So I think that could be a challenge.
I'll go next. My points are actually quite like Laura's. I think for insurers, certainly the pulling together of some regulations into the one source, price walking being the obvious example, that is a positive. People are all being focused on the one source, and similarly, so there were some provisions, for example, around management of claims that were in sort of non-binding guidance to the current code. Again, they've all been pulled through, so it's just helpful to have everything in the one source. Challenging point, totally not an insurer specific point, but just, and you've run through it yourself, Jerry, like the sheer level of work that is going to have to go on within firms. Louise talked about it as well, different groups in firms, very significant projects. Of course, we are here to help.
Louise, how about you?
I would say the targeted approach is quite good to different sectors. So, for example, on MICA, there's nothing in there on MICA because the central bank is doing a gap analysis of whether additional consumer protections are actually needed in that area. So similarly to how payment services would be scoped out of some of the code currently. The challenge, it is all about forward planning and how you line up all these different parts of the business and you make sure that you're ready for the review on time.
Patrick, coming to you.
Yeah, there's a lot more coherence, and that comes from consolidation, and that has to be a good thing. The challenge that firms will face is, and I think fellow speakers have alluded to that, is just the redesigning of products and services, and that leads to a lot more governance and a lot more implementation.
Well, that's from the panel, the challenges and the positives. We asked for your questions when you were signing up for the webinar, and we had over 40 questions. We grouped them, hopefully answered a lot of them in the way we've designed the webinar today. But just to throw out some of those other questions to finish off, Laura, one question was, and this is insurance specific, what do you think the central bank's attitude is to auto renewals, and are they likely to backtrack from some earlier positions?
I think the central bank understands how important auto renewal is in particular contexts, and that's why they paused bringing in changes 2 years ago and just gave that longer time for feedback. Hard to know. I don't get the sense that they're going to backtrack on any of this. The one piece is you would wonder when you look at the categories where there'll have to be a formal opt-in to auto renewal. The one category I think is a little bit, maybe debatable is travel insurance. That a lot of people would see that as quite a critical cover, and the implications of not having travel insurance can be quite significant.
And Laura Corrigan, if I can come to you now, there's one question here, probably dear to your heart. Please expand on how the CPC will interact with the IAF and SEER.
Yes, very dear to my heart, Daria. I think it's a really good question, and one I think we've all been thinking about since the consultation was published. So there's various points of interaction. So the standards for business, obviously under the IAF, were deferred as part of the CPC review. So this now reflects obviously a development under the IAF. But I think also under SEER, there are, of course, prescribed responsibilities, and we can see those being mapped across to some parts of the standards. So, for example, one we were thinking about was prescribed responsibility 7, which relates to stopping the harm. You can see how that broadly fits with an obligation under the CPC to engage in read across. And similarly, prescribed responsibility 21, I think it is, is the responsibility for ensuring fair customer outcomes, which again maps across to the standards for business, which requires fair customer outcomes as well. So I think, unsurprisingly, quite a few points of interaction there, which is good to see.
Louise, if I could come to you now, I can see this is one that covers the kind of things you've been looking at. How, in your view, will the digitalisation requirements interact with other legislation, such as the accessibility legislation and the Artificial Intelligence Act?
So taking the accessibility legislation first, I think the central bank hasn't addressed it other than to say that firms should already be complying with these kind of requirements. So, for example, appropriately designing products so as not to disadvantage persons with a disability. That really goes to what Laura's talked about product design, and what Laura Corrigan's talked about vulnerable customers. And then in relation to AI, I suppose the central bank stance is really that it wants to remain technology neutral, and that's reflected in what they've said in the CPC review. So it's really about applying those principles regardless of the technology that's in place. And in our separate engagements with the central bank, I suppose we understand that there's a reluctance really to talk directly on AI before the level 1, everybody's on the same page on that. So it is a consultation, and maybe there's going to be more on AI. At the moment, it doesn't look like there will be.
Patrick, just to deal with the last question here, what does this all mean for regulated firms who haven't traditionally engaged with consumers, so B2B firms?
Yeah, I think we touched on that point a little bit earlier. The business standards apply to relationships with customers. There's an exception, obviously, in relation to securing customers' interests. So it's always been there. I just think that now that there's been more thought given by the CBI, and the CBI will continue with a regime that has at its heart relationships with consumers, but also relationships with customers, means that with this egregious conduct, with conduct which falls below acceptable market standards, then I think the CBI will be ready to act, either from a supervisory and maybe even as far as enforcement, where there have been breaches. And there have been certain problems, in particular in the UK market, in how small businesses were treated, which didn't attract enforcement action because the regulator in the UK didn't have the tools. That wouldn't have been the case here in Ireland, and I think it would be even less the case over the years if there are problems in relation to the business market.
Well, it just remains for me to thank our cross-disciplinary panel of experts. We hope you found the session useful and that it provided you with a framework for working through and working out what these reforms mean for you. As I mentioned, we have prepared a detailed ALG guide to the Consumer Protection Code review, covers the business standards, and we'll be sending that to you straight after this webinar. And finally, just thank you for your time and your attention.